Wall Street's biggest bear, Marko Kolanovic, just got fired from JP Morgan for being completely wrong over the last 2 years, showing we're in peak bullish euphoria. With the S&P 500 making its 33rd new all-time high in 2024 as weaker data sent yields lower in what was a low-volume shortened trading day. Nvidia and Tesla led the indices higher while the rest of the market follows suit. So is the bad economic data cause for concern, or is it something we should just brush off? Today, we're going to discuss that, as well as a July summer rally setup, expectations for Q2 earnings season which start next week, and JP Morgan's take on everything now that Kolanovic is gone. Is JP Morgan finally going to pivot bullish? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and semiconductors really putting on a show. Look at Nvidia, AVGO, and that actually boosted tech as a whole. Google, Apple, Microsoft, Adobe, Oracle, all of these names were up. Software was very half and half. CRM, Salesforce was up 1.69%, ServiceNow was down, Uber was up, ACN was up, IBM was down. Very mixed price action. We saw same here in financials, mixed price action, same with staples, consumer cyclicals, but Tesla really lifting this entire sector, up 6.54%. Just 4 weeks ago, the stock was trading at 170, now trading at very close to the 250 level. So crazy what a little bit of momentum can do. You know that Tesla is now about flat for the year, and at one point it was down about 50% for the year. Kind of nuts when you look at that. But a lot of sectors were actually fairly green today in comparison to those that were red. I mean, the only red sectors were XLRE, staples, financials, healthcare, regional banks, right? Very rate sensitive or defensive sectors. I mean, banks are rate sensitive, and then healthcare, staples, real estate. These are just defensive sectors. Every other sector was kind of green. It was very risk on. Cyclical assets outperformed, particularly the bigger names. Look at semiconductors, XLK Technology, XLY Discretionary. They all outperformed the SPY. So too did utilities, materials, metals, and GDX. And that was because of the movement in commodities is why GDX and the metal indices were really rallying year today. But despite all of the bullish price momentum, and I do think today was a fairly bullish day if you really dive under the hood, investors are still fearful. The fear and greed index went from the neutral position here at 50 and slightly into the fear position. So there's still a bit of fear in the market, and that is the reason why we will continue moving up. Until we get everybody on side, that's when the market can sell off in a very big way. Now, looking at market breadth, wasn't stellar, but it wasn't bad as well. The Russell 2000, 1,000 gainers, 944 losers. So very half and half. The S&P 500 saw 249 gainers against 250 losers. But when you have stuff like Nvidia, Microsoft, Apple, Tesla, Google, all in the green, upward of 0.5% and above, you're going to see the index outperform. And the S&P 500 did just that, up 0.5%, outperforming the likes of the RSP and the IWM, which were both flat today. Mega caps, the Nasdaq 100 was the best performing asset class, up 0.87% today. Look at this candle. Look at this price action at the top, closing at an all-time high ahead of the 4th of July weekend. Absolutely crazy. Actually breaking out above this little base we formed right here. And I think we should continue higher. We're above the 20,000 mark. Maybe we pull back to this level, find some support, and then continue the march higher. Yields were supportive of equities. They fell for the second day in a row, down 1.78% in the 10-year yield. And as a result, the AGG was up 0.54%. TLT gained 1.31%. And it looks like we're forming actually a higher low relative to this low here in the TLT. Very solid price action. If you ask me, if they could put in this low and continue higher, break above this high, that would be very bullish for long duration treasuries. Now we had some very interesting price action in gold. Gold was up 1.03%. Commodities really did put on a show today. Silver was up 3.25%. And again, this $29 level right here, very strong support. Buyers come in, buy the dip right here, and we continue higher. If we can break some of these highs here in the silver trade, we should see momentum continue up towards the $32, $33, $34 in silver. And crude continues to trade sideways. A lot of volatility, but this generally is a volatile asset class. But we're sort of finding a balance zone here at the top of the $83 level. We'll see if we go higher or lower. I do favor that we could go higher, but upside is very limited, probably to about, I would say, the $87, $86 area. And then we should see downside from there. If not, we'll just get downside from crude right here. But crude at $80 is definitely something Joe Biden and the Democrats don't want. But let's talk about the S&P 500. and actually look at the advanced decline line. Now, we actually did gain in the advanced decline line here today, despite what you saw in the RSP, mid caps and small caps here today. So we saw the advanced decline line actually gained very, very close to new all-time highs. If we could have one more day of very solid breadth, maybe up S&P 500, slightly up RSP, we should see breaking new all-time highs here in the advanced decline line. And then this right here would confirm the all-time highs in the S&P 500, and that means we can actually continue higher. At the same time, we are still a bit elevated here in the RSI. Generally speaking, when it comes to strength indicators, in the short term, being overbought can see a bit of weakness coming to the market, but if we stay in overbought levels for a very, very long time, it's actually good in the medium term. So the longer we stay here in overbought conditions, the better it is for the S&P 500 and longer term investors. But let's actually talk about overall price action we saw here today. Looking at the 5-minute chart, there was just no rest for the bulls. We gapped down ever so slightly, put in a low and then higher highs, higher lows, all the way to closing at a new all-time high in the S&P 500 at 55.37. There's not much to say as to what happened on the daily chart. You zoom in, you look at that candle, you look at the last 2 days worth of candles, very, very bullish. Even after we had this bearish engulfing candle right here, closing at the highs, new all-time highs ahead of the long weekend. This is a big win to the bears. And yeah, we can pull back 100%, but there's a lot of supportive levels down here below. And it does look like we actually have broken out above this level here. This very small island top we formed. One of two things could have happened. We could have actually moved down here and continued lower, close this gap, or we could have broken above. That's exactly what we saw. And with the close right here, I think it favors that we do go to this red line, the call gamma resistance to 5600 into the July OPEX. So stay long, stay bullish. I do think higher prices will come. Looking at the Nasdaq 100, very similar situation. Here's the line, the breakout above. And wow, at 20,000, kind of crazy when you see that. What's the next level we look at? 22, 23,000. Very, very crazy in the Nasdaq 100. And this just looks much more bullish than the S&P 500 as a whole. But let's dive back into the S&P 500. And levels I do want to be buyers of if we do pull back. The very first level I think I want to look at is probably just the 5,500 level. Don't overcomplicate everything. Just the 5,500 level straight. If we do pull back for as low as this level, I'd be a buyer here. And if we do, let's say, make our way down below the 5,500 area, I want to be looking at 54.65. The call gamma resistance, which was previously here, offered very, very good support, and it will probably offer great support if we do pull back to this area. Do I favor that? I don't think so. I think if we do pull back, it's going to be at this 5,500 area, but I don't think we're actually going to see a massive meltdown to this 54.65 area. I think buyers are going to come in, buy the dip, and we're just going to continue the step higher to the 5,600 area. So stay long, buy the dip, sit through the volatility. Higher prices will ensue, especially as we enter Q2 earnings season. This July period, we're in the next 5 to 10 trading days, tends to be very, very bullish for the Nasdaq 100, for the S&P 500, and we normally pull all of July's gains in the first 5 to 10 trading days. That's exactly what we're seeing right now in the S&P 500. So we're probably going to move all the way up to 5,600, and then we're probably just going to trade sideways. So stay long. The volatility will come later on in the month. Right now, you should just be holding and taking all the gains that you can. And for all of the momentum we've seen in the S&P 500, history normally tells us this is generally what happens into the 4th of July. Now, this right here is just a summer setup for the S&P 500 when the second quarter OPEX is positive and the June OPEX week is negative. So we triggered this setup, and pretty much from June's post OPEX week into the 4th of July, we normally see average returns of 1.1%. The S&P 500 is up about 1.3% in that time period. Median change actually 2.41%, 13 up years, 5 down years. So normally leading up into the 4th of July right here, we see very, very bullish price momentum. Then from July 4th to the 11th, we actually have an 11.7 win rate, 0.48% return, 0.57 median return. So still bullish, but not quite as bullish as the first week. And then the week after that, so from the 11th of July to the 18th, we normally get 1.2% average return, 1.04% median, for a full return of 2.79% from pretty much the start of July to the 18th. We could see 2.7% average returns, 17 wins, 1 loss, 2.41% median. Very, very bullish stat when you look at it like this. And momentum brings momentum. So while we might see a little bit of sideways action in the S&P 500 over the next 5 days, we should see that momentum continue into the 18th and the back end of July. So let's talk about earnings. We're going to dive into Q1 earnings, our expectations for Q2, as well as some of the mega cap names. Now, Q1 2024 earnings have come in very, very good. You can see that at the start of earnings season, our expectation was 3.5% for both the revenue and the earnings side. What were the overall outcomes for earnings? 8.2% on the earnings side, 3.9% on the revenue side. And this is why the market has actually remained very, very resilient in the face of what has been a very tough quarter in terms of economic data. But it gets even better, because if you exclude the energy sector, which, let's be real, has been a complete dumpster fire, earnings grows to 11.1%. And if you actually include the energy sector and just remove the one-time 12 billion charge from Bristol Myers Squibb for their acquisition of Karuna Therapeutics, if you exclude this one-time charge, the S&P 500 earnings goes to 11.4%. And guys, this is why the market has stayed very, very resilient. Generally speaking, stock prices track earnings growth very, very closely, but over the long term, stock price appreciation and earnings appreciation are correlated very closely. And if earnings continues to come in at this pace relative to what analysts are expecting, do consider the market to remain at its highs and continue higher. Now, what are the expectations for Q2? This is Goldman's bottom-up consensus forecast for the second quarter. They expect earnings to come in a flat 9% for the S&P 500, excluding financials and utilities at 10%, and then margins for the S&P 500, excluding financials and utilities, at 11.6%, which would be a 57 basis point increase from the quarter prior. Now, looking at the market movers, this is the AI5. It's Amazon, Google, Meta, Microsoft, and Nvidia. And it's just their earnings here for the second quarter. We actually have the third quarter and fourth quarter projections as well, including their net margins, and then a valuation metric just to see where they rank relative to these earnings if it is to materialize. Now, the AI5 is expecting 17% earnings growth here for the second quarter. Kind of crazy. The S&P 500 median stock is 3%. We do know that Q2 earnings is about 9%. So you can actually see that the majority of S&P 500 earnings is actually coming from these 5 names. I'm sure if you include Apple in there and Tesla, things look a little bit different, but the majority of earnings is actually just 5 names in the S&P 500. And that's why the market rally has actually been quite thin, because they are producing the majority of the earnings in the year and now. Same is true in Q1, 22% against the S&P 500 median stock of 2%. Now we can actually see this is actually expected to continue 15% in the third quarter, 14% for the AI5 in the fourth quarter against the S&P 500 median stock of 5% in the third and fourth quarter respectively. And as the AI5 grow their earnings at a higher clip, so too do they for their net margin. So essentially these companies are growing earnings faster and they take home more money on the bottom line. And that's why there's been a lack of breath in the market rally, because these companies are so efficient and they're growing earnings so quickly. I mean, look at Nvidia's earnings, 110%, 72 and 55% here in the second, third and fourth quarter. I mean, even something like Microsoft, this is a $3 trillion company and it's been a mature company for a very long time. 15%, 15% and 13% earnings growth. And look at these margins, 23% net profit margin against the S&P 500, the average company, 13%. And then we actually have a look at EV to sales. Now the S&P 500 median is at 3 times, the AI5 trades at 8 times. And because of this earnings that we see right here, they do deserve to trade at a premium. They also have market leading positions, great businesses, unique businesses, wide moats, and that's why they do trade at a premium. And I do think they deserve that premium. Nonetheless, it is trading slightly more expensive than the average S&P 500 stock. Now let's actually talk about market breadth. Yesterday, I showed you this piece of data right here that 25% of S&P 500 stocks in 2024 have outperformed the market, and this is some of the lowest levels we've ever seen in a very, very long time. In fact, going back to 1974, it is the lowest level of single stock performance against the S&P 500 that we've seen in a while. But in every other case where we've actually had very weak market breadth, like we did in 1980, 1998, the year 2000, all those years have actually finished above 20%. You can see that in 1980, the S&P 500 returned 26%. The same is true here in 1998. In the year 2000, the S&P 500 was 20%. And then last year, 2023, we were up 25%. And in 2024, we are currently up 15%. And so if history is anything to go by, in years where a few stocks carry the entire market, we generally get 20% returns, and we can actually see higher prices in the S&P 500, anywhere from 5 to 10% in the next 6 months. So stay long, because momentum brings momentum. And what normally happens after we get multiple years of thin rallies, we actually get broadening out. So stay long, hold the S&P 500, buy high quality businesses, or just buy the S&P 500, because the market will broaden out and you want to capture those gains. But for now, ride the tech wave, ride the earnings wave. You want to be exposed to technology, because history tells us for the next 6 months, higher prices will likely ensue. And something else that no one is really talking about is that the market is actually becoming increasingly more driven by earnings over multiples. This right here is percentage of year-over-year return of the S&P 500 driven by forward EPS versus forward PE multiples, 1986 to 2024. A huge set of data right here. So this dark blue is EPS driven rallies, this light blue is multiple driven rallies, and this is where we are right now. It's at about the 65 mark to be exact. 65% of this year's rally is actually driven by earnings, 35% is actually driven by multiple expansion. That's very, very healthy. And oftentimes this leads to higher prices, because after we get a rally driven by earnings, we actually get a multiple expansion rally. We actually get a rally driven by multiples, and that's how the market ebbs and flows between EPS driven rallies and multiple driven rallies. So momentum brings momentum. You want to hold equities. We're in a prime environment for equities to outperform. Now this right here is a very interesting take from JP Morgan's Alpha Insight team. We read up on Goldman's take a couple days ago. We read up on BofA's take yesterday. Today we're going to be looking at what JP Morgan think about the half just passed and the year ahead. Now they say positioning Intel, tactical takes, US positioning back at year-to-date highs. How concerning is it? 3 months ago, we were also approaching quarter end. The market was at all-time highs and positioning was elevated. In many ways, the backdrop seems similar. Although the S&P 500 is 5% higher and the S&P 500 equal weight is down 3%, the Russell 2000 is down 4% quarter to date. With our US tactical positioning monitor, TPM, showing an aggregate level of positioning that's backed by 1.0Z, 90th percentile since 2015. Our concern should one be that the market is about to head lower. Our view is that despite elevated positioning, we don't see clear evidence of a broad-based euphoria that would suggest a correction is very likely in the near term. Like we saw for much of Q1, positioning can stay relatively high for a while, and the setup does not appear to be as extreme as Jan 2018, which some have referred to. However, a modest pullback like we saw in April wouldn't be too surprising, and it's also getting harder to point a clear flow or positioning tailwinds, so upside could be limited in the near term. When it comes to bigger corrections, we'd most be concerned if medium-term trends in positioning were to show signs of turning negative. So both will pretty much say, hey, we could see near-term volatility, but it's likely we do move higher. Positioning is not as stretched or not as euphoric as some might suggest. So let's talk about the economy. We got the S&P Global latest PMI June update. So they say new orders rise for the second month running in June, and this pretty much details how the US manufacturing industry is rolling. And you can actually see for the second month, new orders rise. We saw a massive uptick in PMIs, not quite what we saw in 2021, but definitely reverting back to its mean from the lows we saw here after the sharp pullback in 2021, 2022. And while we're still below the pre-pandemic average, we are definitely moving in the right direction. You can see at the key findings right here that we saw solid expansion in staffing levels, new orders rose, and the report also outlines the weakest increase in selling prices in 2024 so far. So long story short, orders up, employment up, price inflation down. Another key parameter that we always look at is US rail traffic. We get to it as often as we can, and US rail traffic this week, total intermodal units looking really, really strong. And you can see on a year-to-date basis, total intermodal units is up 8.8%, and that includes the absolute shit show that is coal. And we do know why coal is actually down so heavily. Coal is actually in a secular decline, down 17.7% for the year. It actually has the highest cart load and the highest cumulative load. So to actually see these figures right here, despite what we're seeing in coal, is very, very constructive. And this data right here literally tells us that a US recession is not imminent, in fact, nowhere near, especially when you dive into the details. So yesterday I showed you guys this is the US federal employment tax receipts I pretty much outlined that in June, tax receipts were very, very strong, and they were also strong here in May, April, March, February, and January, all increasing 1.4%, 6.1, 7.3, 4.3, and 8.1% respectively, for a total gain of 6.3% for 2024. Now, I want to expand on this data by reading a Twitter post that was very, very interesting. So due to strong payroll taxes and a large-ish tax collections at the April and June IRS payment deadlines, the US federal government has run a $100 billion surplus rather than a deficit in Q2, which is April to June. This means that the supply of monetary assets has not kept up with the nominal 5 to 6% US economic growth, which is the red line in this recent quarter, according to this image right here. As I predicted, this has caused mixed economic data in the second quarter, leading to some misinterpreting it as a slowdown / possible recession in the US. But that ends now as the US heads into larger fiscal deficits from July into August, and the net increase in US monetary assets catches back up with the red line by late summer, early September. So essentially, because of the structure of tax receipts and tax payments and how the year is structured, the US government currently have run a surplus. This has resulted in mixed economic data, but this should see massive upward movement to the red line in the next quarter, which should bode really, really well for the economy. It should bode really, really well for liquidity, and that in turn is going to bode really, really well for stocks as a whole. Now guys, as we get into this 4th of July weekend, I just thought I'd give you guys an update with regards to the undervalued portfolio, just to see where we're tracking and how we're going. Now, year to date, the undervalued portfolio is up 26.82%. Very, very good. And that compares against the S&P 500's return in the year of 16.75. Now, the S&P 500 has done very, very well. One of the best performing asset classes this year. And in fact, this portfolio has actually outperformed the Nasdaq composite. Very tough to beat both those indices. Now, we recently did have a change in the undervalued portfolio. So we sold out of F5 right here, and we actually bought into Paycom Holdings right here. So F5 is out, as you can see. There's 0 in the holdings, and the other stock is Accenture. We actually got rid of this at the end of Q1. So we've only had 2 changes to this portfolio, and the results are very, very good. Now, looking at the total return for each asset in the portfolio, we only have one down stock, that's Cisco, down 6.7%. You can actually see every other stock is up here in this portfolio, except for PayPal. Sorry, my bad, I didn't see that PayPal right there. But Paycom is just in the green ever so slightly. I do think it's going to do very, very well. And the best performing asset is actually Nvidia right here, followed by stuff like ASML. We also have Google in this portfolio. Portfolio's done very, very well this year. Now, looking at my other portfolio, this is the top picks portfolio. So year to date, the top picks portfolio has actually returned 53.4%. Again, this compares to the S&P 500 at 16%, the Nasdaq composite of 23%. This portfolio has been absolutely stellar. It's only got 5 stocks. The undervalued portfolio is more of a growth at a reasonable price portfolio. This is more of just a all growth / momentum portfolio. There's only 5 positions right here. There's been no changes from the year, and it's just AMD, Celsius, CrowdStrike, Alphabet, and Nvidia. And you can see the best performing stock in this portfolio is Nvidia. The worst performing so far is Celsius, but every other stock in double-digit gains, including AMD, and hopefully, I do believe Celsius should get a ramp up soon. At one point, the stock was up like 50%. And I do think Celsius will continue higher. Just my 2 portfolios. Thought I'd give you guys an update as to how they're tracking. You guys can go ahead and copy these if you want. I still think you get outsized returns from these portfolios, even after the massive rally in both of them.